What's going on, YouTube? Welcome back to my YouTube channel, the Goofy Investing, where we talk about investing in the stock market. This stock is going to be going over CROX in Q2 earnings, if you will. So, all right, let's jump right into it because I don't want to make this too much of a long video. All right, so CROX reported earnings and we got beats. Okay, beats across the board. All right, revenue growth beat by 3.6% of annual consensus estimates. So, or 1% revenue surprise. So, revenue growth was 3.6% year over year. Revenue surprise 1% beat. All right, so they were expecting 1.1 billion, or and then Crocs came in at 1.11 billion, or 1.10 billion was expected. 1.11 billion was actually what happened. Consensus estimates for EPS was $3.59. Crocs came in with a $4.01 beat. That's 8.4% earnings surprise and 11.7% growth year over year. Okay, so now that we got that out of the way, let me talk about the earnings call real quick. Just to summarize it, um, pretty much Crocs guiding for a cautious consumer back half of 2024. And that's to be reflected in the overseas markets as well, China and so forth. There was triple digit growth, I guess, comped from last year. And for China is now, they've reported 70% revenue growth in China. And I expect, even though the growth is slowing from a comp basis, I think it's due to a conscious consumer in China. I do believe that there will still continue to be strong growth, 70% going forward in China. And I think that revenue will exacerbate to actually start impacting the total revenue of Crocs. And that's including the other overseas markets, your Australia, Europe, etc. So I think it'll still take a while for that international growth to start impacting Crocs as a tailwind in a positive way, as it pertains to revenue growth. And I think that probably going to take a little bit longer. We're probably going to see some of those residual effects. I think, me personally, I think it starts kicking in the back half of 2025, another year from now. So we'll let that growth continue to work. There is SG&A increase to support that growth as well. So let's talk about some quantifiable aspects. All right, they bought back with their strong free cash flows. They brought back. They paid down 200 million in debt for the quarter, and they bought 175 million worth of stock. 1.2 million shares off the market, average price of shy of 150 a share. I think they could have probably bought back at a shorter range, of course, but I mean, it is what it is. 175 million, taking 1.2 million shares off the market is good. All right. Let's talk about the free cash flows of the actual, because this is the strong point of Crocs. That's why we're here. So they did 330 million. Let me see. Let me put this back. Bear with me. Go on the cash flow statement and we'll go quarterly. So for levered free cash flow, they had 330 million. All right, 330.5 million. And levered free cash flow is, if you've been following along, you should know this is the cash flow after debt interest has been paid. All right, the free cash flow that's really free. Okay, comping that from a year ago, from June 2023 for Q2 2023, the cash flow was 259.2 million. So that's an increase of free cash flow year over year of 71.3 million. Let's do the actual percentage comp, if you will. So if we take free cash flow from, and we're doing levered free cash flow of from Q3 of last, or Q2 of last year, I'm sorry, and we divide that by the cash flow of this year, we get the percentage gain of it. So -1. So that's 21% increase in free cash flow. All right, year over year. All right, and that's not a stat that they post up on the actual earnings themselves, but that's something to consider because that's where a lot of the value is going to start kicking in. Debt pay down, the buyback, and that leverage free cash flow, that margin between leverage free cash flow and unleveraged free cash flow, that difference, a little bit, there's 18 million worth, 18 million in there worth of the spread between your debt interest payment obligations and from your unleveraged free cash flow to leveraged free cash flow. As they continue to pay down debt, you'll get you'll get more organic value, contribution to the free cash flows long term going forward. All right, so let's talk about some other things here. I want to hit up on margins here. All right, so here's our margin outlook. So and or Q2 highlights of the margins. Um, Gross margin increased. Okay, so adjusted gross margin is 61.4, increased by 330 basis points. That's a fancy way of saying 3.3%. um, Operating income. All right, so as far as SG&A, that SG&A is increased, so margin contraction of 420 basis points. Excuse me, 4.2%, if you will. All right, and operating margin contracted a little bit. Overall, it's kind of even out. They can adjusted numbers are. I'm not going to discount them because they're not. I'm not going to discount them because there's importance in adjusted operating margin or anything adjusted, because the company is using these adjusted metrics from a business standpoint. Your bears will say, "Well, they're just making stuff up and blah blah blah." Well, yes and no. I mean, they're aggregated numbers, but they serve more from an operational standpoint. So overall, I'm happy about everything with the earnings, real strong. They didn't really guide up though. Let's go out to their guidance. They're pretty much maintaining their guidance. EPS guidance was raised a little bit slightly, but nothing significant. But that doesn't take under consideration any buybacks that they're doing. So with the buyback effect, if they buy something buy back in Q3 and Q4, maybe it bumps up more. All right, maybe we do $13. All right, maybe I'd be happy if they do $13. Given that the stock right now is under 130, so that's an EPS performance of contribution of over 10% of the price, if you will. So overall, I'm happy with the numbers. I can sleep good owning this company. Owning this company is very easy, and the international growth is just the potential for international growth will fuel the growth of the business moving forward for several years to come. Let's talk about something I didn't like. I did not like the revenue. I don't like the revenue decline. We're still contracting with Hey Dude, which is unfortunate. But at this point, the Hey Dude percentages of revenues is like 18%. Nothing to sneeze at, but still, we're gonna have to give Hey Dude a little more time. But for the long-term effects on the management call, CROX, the management is still bullish on Hey Dude long-term, and I'm a long-term investor, so I'm gonna continue to hold these shares. We'll pull up my position. I hold 200 shares. Cost base is about $100 a share, and I do have some hedge. I have some covered calls running against CROX, so Those covered calls are giving some protection, and I have used those covered calls as a forced yield function that won't affect the intrinsic energy of the stock, because it's coming from because the premiums are coming from a third party, if you will. So I may decide to scalp this covered call if we continue to go down and see more contraction in recessionary scenario. If you've been following along, I have been guiding that I think that Q3 is going to have employment turbulence, and that thesis is already starting to play through. Stay tuned for more videos on how I'm strategizing for that, and so forth. And you can actually look at prior videos too. If you're getting value out of these videos, like and subscribe. All right. Comment down below if you want me to cover another company. Check out my Patreon link description in the video. Join the Looney Syndicate, join like-minded investors, get access to the hidden gem collection and exclusive different products that are included in the membership. So with that being said, thank y'all. I love y'all. Thank y'all for your support. And until the next time, be on the watch out for my next video. Take it easy.